An all-star panel now to discuss why the Fed did what it did today, or more appropriately, didn't do, and what it all means for your money. With us is Randy Krozner, a former Fed governor, now a professor at the University of Chicago's Booth School of Business. Bill Gross, co-CEO of PIMCO and manager of the world's largest bond fund, PIMCO Total Return. Full disclosure, I am a shareholder in that fund. And Barry Knapp is the head of U.S. equity portfolio strategy at Barclays. Welcome to all of you. Bill, let me begin with you. Three-headed question here. Did the Fed surprise you today? Did the Fed do the right thing? And are you and your shareholders happy this evening?
Last question first. Very, very happy, Tyler. You should be happy. Did it give us a surprise? Yes. You know, the Fed gave us not only no taper, but I think importantly, very dovish modifications of the unemployment rate, which might mark the beginning of policy rate hikes at some point, perhaps as far out as 2016. And not only did Bernanke, dismiss the 7% target that he was using, for taper, almost like a magic slate, but the 6.5% level, which he had referred to before, he suggested that didn't apply either, and that it might have to be considerably lower to precipitate higher interest rates. So this was a positive day for bonds, a positive day for higher prices and lower yields.
Randy, how did almost everybody get it wrong on Wall Street? I mean, we had so many people on TV all over the country on various different networks talking about the fact that the Fed was going to taper and that it was kind of baked into the market. How'd they get it all wrong?
I think they didn't take the chairman's word seriously that he really is driven by the data, and he doesn't get boxed in by just starting to talk about the possibility of the step down. You have to remember, the economy looked stronger back in May, June when they were talking about this. Over the last 3 months, the employment growth has not been as strong. Although the unemployment rate has come down, it's come down for the wrong reasons, because less labor force participation. And so he really is driven by the data. And in particular, exactly as Bill said, I think the market surprised the Fed a little bit in how much they moved rates up in response to just the talk about the possibility of doing this. And so the Fed kind of responded by saying, well, we didn't think that the impact should be that much on the markets, and we're concerned about that much of an impact on particularly housing. So we're going to wait and see.
Barry, let me turn to you. I heard Bill Gross earlier today described today as a risk-on kind of day, and presumably moving forward at least for as far as the next Fed meeting goes. Is it a risk-on day for you in the world of equities, Barry? And if it is, how can it be if, as Randy Krozner just said, the data on the economy are worrisome to the Fed?
So I think I'm going to give you an answer that's a little bit counterintuitive in the sense that we don't necessarily think, in some ways it's risk on in terms of carry trades, anything related to fixed income. Our highest conviction trade at the beginning of this year, when the narrative was QE forever, was buying stocks with bond-like characteristics. The idea that spreads would tighten across a range of fixed income products. Ultimately, that would push investors into the parts of the stock market most closely correlated to the bond market. That trade really reached its peak of outperformance at the end of the first quarter, and then it started to shift to cyclicals in the second quarter as the economic outlook improved. The so-called equity risk premium started to contract there, telling you that the growth outlook was improving. Now, what happened today was we had utilities rally almost 3%. There's a real question, and first of all, we don't think this takes us to October. It probably takes us to December, whether everyone will just pile into the parts of the stock market that don't really drive growth, that don't really drive employment or capital investment. It's a wealth effect dynamic, but it really is not a macroeconomic positive. It'll just be people buying what generally are somewhat unproductive assets, buying stocks with high dividend yields.
Yeah, Bill, let me turn you to one of the reasons that the Fed cited for not pulling back on its stimulus, and that was the looming impasses in Washington, the debt ceiling debate, the budget impasse that we seem to be having, the increasingly vitriolic conversations that are going on between either side of the aisle and the White House. What kind of volatility are you anticipating as we get closer to those deadlines might be inherent in the stock market and the bond market?
Well, we expect volatility. We expect headlines one way or the other, but we expect resolution. We've seen this before, and PIMCO expects at some point in October for there to be a resolution in terms of the debt ceiling. There's no doubt that Bernanke is concerned about it in terms of fiscal policy. He's spoken to that, 6, 12, 18 months ago for a long time. In addition to that, Sue, let me just add that the Fed focused today on inflation.
Yes.
Their inflation target, the PCE, the core PCE, is really only moving up at 1.2%. They've got a target of 2, and so the Fed really wants to raise that inflation rate. They want to reflate the economy,
Right.
and so any asset such as tips, that are dominated by inflation should do very well.
Randy, very quickly, what's wrong with this economy if the Fed is concerned about it? And would you have voted the way all but one of the voting members today voted, and that is no taper?
The economy's been, in what I've been calling for the last year and a half, a sideways slide. We have some job growth, but not really strong job growth. We have some investment, but not a lot of investment. And so we just aren't getting the push forward. I think with this step down in data, I probably would have gone along with the consensus and said it's okay to wait and see, because as Bill just said, we don't see inflation on the horizon.
Randy, Bill, Barry, thank you very much for being with us and clearing it all up for us tonight.